My guest today is Mark Thompson from Murtagh's Mortgage Brokers. Property has always been of interest to Mark, so much so that he worked in the industry as a real estate agent for 2 years before starting a career in the banking sector. He worked in the banking industry until mid-2018 in both Australia and New Zealand. His time in banking was spent working across several sectors including private, commercial, personal banking and agriculture. Eventually, he took a leap and left the banking sector, moving into the mortgage advisor space, working with Waikato's first mortgage advisor business, Murtagh's Mortgage Brokers, which he purchased shortly after joining. Since then, he has assisted clients with buying their first home and other clients with buying large quantities of rental properties, obtaining approximately $250 million in finance for his customers over the last 4 years. Welcome, Mark. It's a pleasure to have you here. Thank you for coming in. Tell me, why is home ownership so important?
I think there's a number of reasons why. If I think of a couple of topics around home ownership, is socially it's been seen as a must-have. You have to own your own piece of own property. There's a saying that I hear a lot, and it's from the older generation. From many years ago, talking about you have to own a piece of dirt. And that applies in both Australia and New Zealand, because I'm from Australia, so I've heard that a lot over there as well. There's another element to that where we talk about wealth creation. It's a default for people, both Australia and New Zealand, talking about home ownership, and that's the default. The first thing they look at is you've got to own a property. You can create, you can generate or accumulate wealth through home ownership, and that's through equity or leveraging that equity to buy the next property. There's the security element to it as well, where you own the property. You're not exposed to a landlord that could potentially sell the house, and then you're up and moving, and you've got young ones to consider, reschooling or whatever perhaps.
So security.
Having to move into a different area. So the security element of it, you've got security in knowing that, the decision to move is yours, not someone else's. Another element to that home ownership being important, I think, is that wealth creation piece. Again, going back to the mindset, a default, so you have to own your own property. The wealth creation element to that is obviously the longer term picture. When you're looking to move into retirement, finish work, your income earning capability will reduce. So you'll want to have paid off your home then, and your focus is really about your expenses, your expenditure, and having a reduced income. So that's another element to it as well.
Yep, great. A powerful start for people. Is a home an asset?
I think if we talk in general, yes. And I say in general because when people buy a home, they don't generally factor in the maintenance costs. That's not at the forefront of their decision making. Maintenance costs, the insurance costs, rates, etc. Those sorts of costs. If you look at the likes of your general population and a lender, for example, they would look at it as an asset, because you can leverage off that, and a lender would take security over that to lend you money. So in that respect, yes, it is.
You see a lot of conversation about the historic change in property values. Can you talk about that a little bit? And what's actually going on there?
Yeah, it's interesting because I've been around property since the early 80s, and if we look specifically at the 90s, 1990 to 2000, that 10-year period, property prices were pretty, I'd say, not stagnant, but there was a bit of a plateau around the market, with not a remarkable increase in values over that time frame. And then 2000 to 2008, pre-financial crisis, there was a marginal improvement in values of properties, a little bit more than marginal, I'd say, for reasons being interest rates were relatively low. there was a little bit more demand for properties, and there was probably a bit of a lack of property availability around the country. Auckland would have probably been seen as the city that improved in value the most, or increased in value the most. And then we go post financial crisis. So we look at, say, 2010 to 2020, where prices just skyrocketed. There was a real surge in values, and that again comes back to incredibly low interest rates, high demand from onshore and offshore buyers, and I think this lack of supply as well of properties. So a number of contributing factors to that significant increase in values through 2010 through to 2020.
Yeah. To 23, 24 as we are now. And yeah. How do you get into your first home? And what hurdles do people face?
I think the biggest hurdle that I'm seeing today is that deposit. So the deposit's going to be a key, having a good deposit. Banks will lend if you have a 10% deposit, ideally 20%. And I'm seeing mum and dad come in more so now than ever before, with some money to help out. Not a lot of money, but anything can help in today's market with a deposit. That's one of the biggest hurdles, is the deposit. I think I'm going to use the term tenacity. You've got to have that not give up sort of attitude. What I see a lot of people going to the bank says no, and I've had people come to me and say, why did they say no, and why didn't they tell me what to do? You know, what next, where to, or how. So you need a bit of tenacity to not take no as an answer, and to just keep pushing on until you get to a place where you either find out really can you buy, or if it's not now, when, and what do I need to do?
So two things jump out at me as you were talking there. One was if the bank is saying no and it's still very available to people, what are the mechanisms they're finding or working through to get that no to become a yes?
I think it's asking the right questions. You know, if it's a no, I never see it as a no. It's always a not right now, because if it's not today, in 12 months' time, your position could improve significantly. So I think it's asking the questions. A lot of people don't, I think, know what questions to ask. They don't know to say, hey, well, if it's a no, why is it a no? And to have that sort of courage to ask and keep asking until you get the answer.
Yeah.
And so you know what to fix to make it so that in 12 months' time, if it's 12 months' time, that you can afford to buy a house or borrow the money to buy a house.
Yep. So if it's a no, we're rephrasing that to a how do I make it a yes, or what are the steps I need to take to make this a yes?
Yes.
You know.
Exactly.
Yeah.
Yeah.
And when you talked about the parents coming on board, is that simply a case of the deposit is too hard to save? And do you think it is too hard to save, or is it people not wanting to sacrifice lifestyle, and it's easier to call on bank of mum and dad in the meantime than doing the hard yards to get that deposit together?
Yeah, I think it's a good point you make. I see more often the deposit being difficult to come by, not just based on the last decade of price increases of properties, but if you think, you know, the average price across the country is nearly $1 million, or the median's nearly $1 million, you need $200,000 as a deposit, and then you have to go down the path of proving affordability of an $800,000 loan.
Yeah.
So it's hard to save money for people. It is hard to save. Yep. $200,000 is a lot of money. If we're talking specifically a first home buy, you can get a $600,000 home as your first home. There's $120,000. Now we're getting to a point where KiwiSaver's up there as far as value goes. It's been around since 2007. So, you know, the values in the KiwiSaver is quite high. Most people would generally live to their means, albeit putting money into KiwiSaver. Comes time that they look to buy a house, and they've got 80,000 in their KiwiSaver, and they need another, might be 40,000 to buy a $600,000 house with a 20% deposit. A lot of times, mum and dad will then come in and say, "Okay, we've got some money available for you." I think, in general, if I talk generally, the mindset is I'm saving, and you are in KiwiSaver. You're saving. People don't necessarily make a distinction between KiwiSaver savings and savings into a bank account as such, because there's so much emphasis on putting it into KiwiSaver and using that later on for a home.
Right.
So I don't think it's a case of I'm just going to lean on mum and dad at some point in time.
Yes.
I don't think that's the case. That's not what I'm seeing.
Yep. And for our international viewers, New Zealand's superannuation scheme is called KiwiSaver.
Yes, that's right.
So it's, yeah. So if people are struggling to get that deposit, or they're using their superannuation as a form of saving, what other things could people do to get that deposit together and do whatever they need to get into that first home?
Well, if I go back to what I mentioned earlier, you don't need to have a 20% deposit. 10% deposit is an option. So if you're looking at a $600,000 house and you've got $60,000 for a couple, generally they've got that available in KiwiSaver and a little bit more. So, because I always say your ability to save won't keep up with the property price increases.
Yeah.
So I think have a look sooner rather than later, even if you don't have the 20%. The things that you would look to do would be budget, and don't do those lay-bys where you buy now and pay later. If you want to buy something, wait 4 weeks and pay cash for it if you really want to do it. If we look at what the lender's looking for, it's that the spend, where your money's going. Because they'll look at your bank statements and they'll look at the history of your bank statements. They look at where your money's going, what you're spending it on. So just be sensitive to that, and ask yourself, do I really need that? Do I really need to go up to Auckland for a shopping spree? We all do, but
yes.
When's the right time?
I find it fascinating that the superannuation is such a big part of that. I mean, you're supporting a lot of people getting into homes. How many, like in the terms of a percentage, are drawing on superannuation to get into their first home? Is it most?
Yeah, I think at the peak, and we're going back just, if I can talk pre-2020, just before then, so 2018, 19 and into 20, it was about 30% of the people that I was seeing were first home buyers leveraging their KiwiSaver. At the moment, that's come back a little bit just because first home buyers have come back to the market. So we're probably looking at around 15 to 20% that are looking to take out their KiwiSaver now.
Yeah. And the others are saving their way there, potentially 2 incomes, saving 1 income, or what other ways of getting there are you seeing?
Yeah. Aside from mum and dad,
yeah.
which has picked up a lot in the last few years, it's a combination of dual household income and a good saving habit.
Yep.
Just determined to get out of that renting cycle and get into a home, and made some tough decisions to do some budgeting, sitting down probably once a week and chatting about where we're at, what we're doing, and just being a little bit, refraining from going after those buy now, pay later type things.
Yeah. I've seen in the news a few examples recently of friends all banding together to buy a house or get in so that they're on that property ladder. What are your thoughts on that?
As a whole, I like the idea. I think it's a good concept because you've got a combination of incomes and deposits that make it more favourable, and the lenders now are seeing that as an option more so than they used to. the one sort of thing for me that I when I talk to people about who are looking to do that is what ifs. I'm a big what ifs type of thinker. I think, well, what if, friend over here decides they want to go traveling, or they want to move over to Australia and they want to get their share out of the property? Will you be in a position to do that? Will you be in a position to leverage some more money to give them the money that they've put in, plus whatever capital growth has taken place in the time that they've owned it? I'm a big what ifs believer. If it could go wrong, will it go wrong? Will you always remain friends? Yeah. So I think as a whole, it's a great idea. For long term, maybe not so, because at some point in time, your friend will want to maybe go off and do their own thing somewhere else, whether that be get into their own place and have their own space entirely, or they might meet a partner, get married, go off and have a family and want to do that anyway.
So what are the different ways people use to manage that? Do they have like agreements that they like written agreements that they're coming into with it, or?
Yeah, my recommendation is get some legal advice around those sorts of things, and what you'll find is the solicitor will give you the what ifs in black and white. What that means to you if this happens and you can't do this. I mean, I'm not a legal practitioner, and I don't want to be, but I always recommend that people get some legal advice. Independent legal advice is my go-to.
Right. What does it mean for people if they've got family or friend involvements in it? What are the implications of that?
Yeah, family. Yeah, I think you'd rather have a fallout with a friend than your family, right? Over money. Other implications of having family or friends involved would be if there is a change of mind for whatever reason, or family or friend decides they want to get their money out of the property, or they want to move on to something else. It's coming to an agreement on what was contributed from the get-go, who put what in, who's paid for what. And we are talking worst case scenario if someone wants to move out of the arrangement, and then agreeing on a value of the property when it was purchased, which is generally purchase price, which is easy to arrive at, but then what is current market value, and who does that?
A process to work through.
Yeah.
What type of home do you think people should buy as their first home?
That's a good one, because I often say, I'm not very good at cliches, but I have one. When looking at your first home, always bear in mind that it's not going to be your forever home. You might own it long term, but you may not necessarily live in there long term. So in 5 years' time, you might outgrow it, or you've done what you need to do to it. You've put some cosmetic fixes in place to make it look really good, and you decided, well, let's move on to the next one. So I think always have a budget, but go under your budget. I've had people come to me, first homes, they can afford to go up to $800,000, for example, and then they find something for $650,000, and I think that's a really good outcome. When you realistically, when you think about it, it's a lot of money. So don't meet your budget. Find a property that comes under your budget, knowing that it won't be your forever home.
What happens to people who don't stick to their budget and end up over it? Do they end up, or do you see them ending up into financial troubles, or do they often just do what they need to end up in a strong position still, and perhaps looking back go, oh gee, I'm glad we stretched ourselves into that?
Yeah, the latter. I've not seen anyone that has come into a financial difficulty because they did go in and buy a higher valued property, and they soldier through it. They, even though we've had rates increases that we've seen over the last 18 to 24 months, people are knuckling down and, some are doing a little bit of extra overtime working on the weekend, and they're making it work. And they're still relatively happy. When I speak with them, they're comfortable with their decision.
Yeah. Talk about the application process. So someone decide they want to buy a first home. Do they go and buy a first home, then come and talk to you, or are they talking to you first, and what's involved in the process of getting them into that first home?
Yeah, a lot of clients will find a house and occasionally make an offer on that house and then come and see me.
Yeah.
But mostly they will do the groundwork beforehand to know what their budget is. And that's what I recommend. Do it that way around, so you know what you're looking at, and you know what budget you're in. The process itself is it's relatively straightforward. It's a bit of information gathering, lots of questions, having a conversation like this with clients, sitting down with them. Sometimes, I've been sat down with clients for 2 hours having a conversation about why, what, where, how. And I can sit down with them and go over some numbers and just give them an indication there and then. I try not to do that, because ultimately the bank will make the decision, or the lender will make the decision as to what someone can borrow, what's affordable. I can give someone a guide as to what would be affordable. A lot of the application process is done online because we have a customer management system where a client gets a secure link with a secure login code. They log in there and it's all there. They're at the user interface and type it in through the computer, and they can upload any required documents onto that as well. So it's changed a lot over the years. I've made an attempt to go not quite paperless, but as little paper as possible in the office.
Yeah. Is that process different if they were going to go towards a auction, for example?
No, it's the same process. However, going to an auction, you need to be unconditional. So there's no subject to, making an offer subject to being approved to take my KiwiSaver out, for example.
Yep.
You need to have all that done prior. Auctions are a tough one for a first home, I think, just purely because you get into a room with a couple of people, it becomes competitive, and not everyone's budget's the same. Someone might see a bit more value in a property and decide to keep going.
Yep.
And I think auctions for first home buyers could probably prove to be a little bit traumatic because it is a bit deflating knowing that someone over the other side of the room there can just keep putting a number on the board and your budget, and you don't want to get too carried away or emotional in that process, which you can do in an auction. But same process, and the only I'd say difficulty around the auction is if you don't have a 20% deposit and you're looking at an auction, the banks or the lender will want a registered valuation of a property.
Yep.
Because you don't have that 20% deposit, and you're not assured of being successful at buying any property, any sales method. However, at auction, you need to have all the process done prior to auction day, so you can go unconditional, and that means paying anywhere from $1,000 to $1,500 to a registered valuer to go around to the property to value it, and then you might pay for a builder's report, which will be $500, get a LIM report from the council, and you pay for all this up front, so that on auction day you're unconditional, and you go to the auction and you lose by $5,000.
Yeah.
And you've just spent near that on getting you in a position to be at the auction. So yeah, and I think in the current market, what I'm seeing is auction isn't a preferred method at the moment, so which is a good thing.
By the banks or by the agents and the
agents?
Home buyers?
Yeah, agents. There still are a few, but they're not it's not as popular as they were 2 years ago, and that's the cycle of real estate.
Yeah. Why should someone go through a broker? and not just go straight to a bank?
It's a question I hear a lot, and it's a good question. I would just say that if you go directly to your bank, it's quite one-dimensional. They've got their list of products that they will talk to you about, and they may not be necessarily suitable for you at that time. We cover all lenders, and we know what the lenders are looking for, and we can quickly ascertain who's going to be the most favourable for your situation, because it's not a cookie cutter process. Everyone is quite unique, and every lending application is actually different to the last. So we have exposure to all the lenders, we know what their criteria is, and we can quickly ascertain where you're best placed, as opposed to going direct to the bank and they say to you, this is what we have, unfortunately it doesn't work for you at this point in time.
Yep.
Possibly.
So if you've got one property, you got into that first home, and then you're looking around all these other people who have got 2 to 80, you hear in the media of people with 80, 100 homes. How do you turn that one property now into 2, and then into 3, into 4, into 5?
Yeah, it's a good question. Again, it's a case of, look, not multiple property ownership is for everyone. It's not everyone's cup of tea, but there are certain people out there that really are really determined to do that. And for those people, or for anyone that's considering it, it's about budgeting. It really is. And when you first take out a home loan, you've got the option of just paying the minimum. If you can afford to pay more, pay more. So if I gave you an example of paying the minimum over a 30-year term of a loan, for a $500,000 loan, you end up paying back about $1.17 million. That's about $670,000 in interest costs, plus the principal amount that you borrowed in the first place.
Yep.
If you pay $100 a week extra over the same term, you'll save $220,000 in interest costs. It's about $450,000 in interest costs as opposed to $670,000. So that's one way to look to leverage into your next property, is paying a little bit more. And what happens then is you have a two-pronged approach to it. Is you've got the capital gain of the property, and you've got the reduction in the amount owing against the property. So your equity is growing, and that's a tool to leverage for your next property. So that's one way to do it.
Yep.
And that's the most common way that I deal with clients. They do it that way, just through paying down the principal on the loan and a bit of capital growth on the property, and then leveraging into the next property, renting that one out. That covers ideally all of the repayments. Not always does, but near enough. And then you leverage that to move into the next property.
Do you approach buying a rental property different to buying say your first property? What role does emotion play in all that?
Yeah, I'd say yes and no. I think it's less personal when you're buying an investment property as opposed to buying your first home. And I think if people took the approach they did with buying an investment property to buying their own property, it'd be a different process for them, because you do tend to budget a little bit more. You look at what those outgoing expenses are. So what are my rates on my investment property? What are my as in council rates? What are my interest rates on that? What's my insurance cost? What are my maintenance costs? I think people take a bit more of a broader approach to an investment property with those outgoings.
Mm-hmm.
So yeah, if people did that with their first home, I think it'd be a better outcome overall for everyone. But that's certainly something that's more considered when buying an investment property.
If people were wanting to get into rental property in the future, and they're looking, so I'm going back to that first home buyer for a minute, should they be looking then for that first home to become a rental property in time? What are the advantages of thinking like that, rather than thinking this is the home I want to buy to live in? And then I suppose the traditional way in New Zealand is, and probably Australia as well, from what I've seen there, is to buy the house you want, and then as family grows, you sell that house and buy the next house that you want. And I suppose I'm just thinking from what you were saying there about that, thinking about removing the emotion and having the numbers and working those different facets out. And you said it'd probably be better if people approach their first home like that. What are your thoughts on that?
Yeah, I think it goes back to what I said earlier, where it's not your forever home. I think, and that's the approach to take to it. It's stage of life, right? You're a first home buyer. You want to get into a home, and that's probably the overriding thought in your mind, is to get into your first home. And I always say it's not going to be your forever home. So just think in time, and it might be 5 or 10 years time down the line, that you will outgrow this property, your family might expand, and you'll need to move into a bigger property. And I think that's the mindset that I try and encourage people to take on board, is that it's not going to be our forever home. And when I say it to clients like that, they tend to agree.
Yes.
So, yeah, I just think it's a case of having those conversations with people so they know, putting them in an informed position so they can make those decisions. And it may not suit them to buy another property down the line, but I'd say 90% of first home buyers that I deal with always come back to me and say, hey, listen, we want to buy another property.
Yeah.
Albeit maybe 50% of them go into the property thinking that at some point in time they will. Nearly all of them come back to me and say, hey, we're thinking about buying another property.
So what characteristics define those people who are looking for being a property investor and are thinking, okay, I want to build wealth with property? What kind of people are they? What characteristics are they exhibiting? What makes them good at what they do, or some perhaps struggle or find it more difficult?
I think they're inquisitive. They ask lots of questions. They budget, and I won't say regimented. It's probably a bit of a strong word, but they are a little bit more aligned with that way of thinking. And it's getting together with you, whether you're doing it with someone else or your husband or wife or whatever it may be, sitting down every week and having a conversation around that, looking at your budget, reviewing it.
So being very deliberate.
Yeah. Being very, very measured about their approach to it. Yeah.
That's cool. The media is full of people who have made lots of money in property, but I'm sure there have been people who don't make the media who haven't done so well, or have perhaps failed at property investment. I know myself, I've talked to a lot of people who, it's often a friend of the aunties and uncles, or they've got a cousin or a brother whose friend who works down the road had a horrible experience with a tenant and vows they'll never touch property again. What are the characteristics of success? Because some people do fantastic and some people don't. And so I'm not thinking here about the purchasing that we discussed before, but then I'm thinking about the actual, once you've got the property, what makes some people succeed and do so well with it?
Yeah, I think it comes down to, in part, resilience and determination, because you can be put off by it. If you have a property you've got a tenant in there that may not be looking after the property as much as you'd like them to, or for other various reasons you're not particularly happy with that situation, and you quickly find out that it's not for you.
Yes.
I think there's a resilience and determination about people that own multiple properties versus those that don't, and that is they'll soldier through some tough times. If they've got a tenant they're not completely happy with, they'll work through the problems. It's just being determined, and I think looking at the long-term picture as well, knowing that this is not for 5 years. This is a long-term project as such.
Yep. I had it said to me once, if you expect the road to be bumpy, invariably it will be bumpy, but probably less than you expect.
Mm.
But if you expect the road to be smooth, you'll be surprised by how hard it is, and you'll give up because it's much bumpier than you expect.
Yeah. That's a good analogy. Yeah.
In terms of networks, what does someone need to be really successful in real estate if they're thinking as an investor in particular? Because when they're getting to 2, 3, 4, 5, but I suppose this applies as much to the first home buyer.
I think if we think of the first home buyer and subsequent properties, I think you need to be, I think, open to allowing experts into other areas into your life and into your process. And that's, lawyers, a good lawyer, a good property manager, obviously a good broker, and it is a partnership with those experts in those areas, because you're not going to know everything. So it's an alignment with key partners that are experts in their field that will actually give you the right advice and good advice to move forward. And you're going into these situations in an informed position, knowing that you've got the backing of these other partners that are experts in their fields guiding you through the process.
Do the rules change in terms of financing, but even or any other rules, I suppose, if you were looking to buy a house that you were going to live in as opposed to one that you were going to rent out?
Yeah, they do. There's a couple of things to factor in. If you're buying a home to live in, ideally you've got a 20% deposit, so you're borrowing 80% of the value of the property. And if you're looking to an investment property that is an existing dwelling, the banks require a 35% deposit.
Right.
There's not too much wiggle room around that either. So that means you're borrowing 65% of the value of the property. Now, if you're buying, if you're going to be buying a property that will be an investment property, but it is a new build, you can go up to 80% of that value of that property.
Right.
That's exempt from the those loan to value ratio requirements that the banks have. So you just have to have a 20% deposit for an investment property that is a new build.
You've mentioned a few times now about borrowing against equity, particularly when you're buying into that second or third or fourth property. Can you describe what equity actually is, or what do people think of equity, and is it different to what people think?
Yeah, it is. It is a lot, because true equity is basically the value, what's left over from the value of your home minus what you owe. So that's true equity. So if you have a house that's worth $1 million and you owe $200,000 on it, your equity is $800,000. So if you sold that, you're going to be pulling out $800,000. However, if you're going to the bank, the bank's equity position is completely different, because they'll only lend up to 80% of the value of an owner-occupied property. So if you own a house that's $1 million, you owe $200,000, your equity position there is $600,000 from the bank's perspective, but your true equity position is the value of the house less what you owe on it.
Yep. So when people talk about, I've got $400,000 in equity sitting in my property, I should be buying a rental property, the bank doesn't see it like that at all.
Not necessarily. If it's $1 million house and you owe $600,000, no, that's not how the bank will see it. It's so that's the common reference when I'm speaking with people about their equity position. When they're looking to buy another property, for example, they will say, I have $400,000 in equity, I owe $600,000, it's worth $1 million.
What happens when you've got different aspects or ways of valuing a property, and the bank might turn around and say to you, we think it's worth $900,000, and you say, oh, but all the websites that list property values put me at $1.3 million. How do you bring that together, or can you bring that together, or is what the bank says it, or are there different ways to address it?
Yeah, you can address it differently with the bank. The bank have a system, they have a couple of systems that they use internally, and they do an iVal, so it's an online valuation, or a desktop valuation is the term that they often use. And they will say to you, this is what we see its value at. often, if a house has been improved, that won't be reflected in the value.
Yep.
So you can go to a registered valuer and have a registered valuation done, and the bank will look at that and then understand that, hey, yes, the IVAL that we have or the desktop valuation we have isn't reflective of the current value of that property, and they will look to accept that as a true value. I mean, you'd like to think that if their value, if you're seeing a value of 1.3 somewhere, on one of those websites or whatever it may be, that may not be the true reflection of the value, because you might have had, it's always an average of a sale price of properties in a particular area. So you might have had a couple of high value properties sold in your area, which has then pumped the price of your property up. And similarly, on the other side, you may have had a few properties that sold for a lower amount, which will then again drag the value of your down. So that is where the bank comes in, and when they do their desktop valuation, it'll be reflective of those average sale prices in those areas. But it can be addressed purely with a registered valuation. If you believe, I've spent $250,000 on my property to bring it up to a certain standard, and that's not reflected in what the bank's looking at, then a registered valuation would mitigate.
Will they always accept the registered valuation, or are there times they would say no, or conditions they would say no to?
Mostly they will.
Obviously, in your experience, you're not speaking as the bank.
If let's say, for example, you've purchased the property within the last 6 months, it's not likely that they will accept a registered valuation.
Right.
Unless you've dramatically improved the value of the property through some work or renovations on the property that they are not aware of. Then, if you've purchased it in 6 months, within the last 6 months, and you go back to the bank and say, well, I want some extra money for whatever it may be, and the bank say, well, we see it's worth, you paid $1 million for it 3-4 months ago, we see it as still being worth $1 million, and they'll still do their desktop valuation to see the difference. Going back to the registered valuation, though, is when you're buying a property and you buy a property over their desktop valuation, they may ask you for a registered valuation to confirm that price for your purchase. So if your purchase price is well above their desktop valuation, they will request a registered valuation, and they'll go with the lower of the two.
Right.
Yeah, there's a little bit of a catch.
So it's a safety net.
Safety thing for the bank.
Yep.
They're risk averse, and you've got to think that the bank is risk averse.
Yep. So you've found your dream. Well, you've got into your first home. You've got it. You're all pumping now. You've got 1 or 2 rental properties. You see another one now that you think is just fantastic. What different ways can people access funding? Is it just banks that you'd recommend, or?
Yeah, I think in that situation, there are numerous lenders out there, and you can explore options outside of the banks to obtain funding for those. You just need to bear in mind it will come at a higher cost than the bank. There will probably be an upfront fee and some higher interest rates if you're looking outside of a main bank for some funding.
Yep.
So that's something to consider.
Are there, well, I suppose I'm just thinking out loud really, but other options that aren't necessarily lender? I suppose then you're just talking collaboration, buying with other people and things. Yeah. I've answered my own question.
Yes.
Thank you so much for coming on to the show today and being our first guest, Mark. It's really awesome and great to have you here and sharing your wisdom. So thank you very much, Mark Thompson from Murtagh's Mortgage Brokers.
Thanks for having me. Thank you.